Inheriting a property can wipe out decades of capital gains tax overnight, but only if you understand exactly how the basis reset works and only if you don't accidentally undo it. Most videos on this topic stop at you get a step up in basis and move on. Today we're going past that into the mechanics that actually determine how much of your inherited property's future sale is taxable. Hi, I'm Sherry Ayland, CPA and tax advisor, and I help my clients pay little to no taxes using my zero tax blueprint. Under Section 1014A1, when you inherit property, your basis isn't what the decedent paid for it, it's the property's fair market value on the date of death. Buy a house for $100,000 30 years ago, and if it's worth $300,000 the day the owner dies, your basis as the heir is $300,000. Sell it for $320,000, and you're only taxed on $20,000 of that gain, not $220,000. Here's the part that gets left out. This works in reverse too. If the property lost value and is worth less at death than the decedent paid, your basis steps down to that lower fair market value. You don't get to keep the higher original cost basis. The reset goes both directions, and there's no election to avoid the step down if that's the situation that you're in. Since your entire tax position depends on fair market value at the time of death, this isn't a number to estimate or pull from a county assessor's website. Get a qualified, independent appraisal dated as close to the date of death as possible. This is your evidence if the basis is ever questioned, and it's the number that determines every dollar of gain or loss on a future sale. This matters even more if you're planning to sell relatively quickly, since a low quality or informal valuation can understate your basis and overstate your taxable gain. It also matters if the estate is anywhere near the federal estate tax threshold, currently $15 million per person, since the same fair market value figure that sets your basis is also what gets recorded for estate tax purposes. Get it wrong in one direction and it can cost you in either the estate return or your future capital gains, depending on which way the number moves. Once you've inherited the property with its stepped-up basis and a solid appraisal to back it up, you've got three directions, and each has a meaningfully different tax profile. First, sell it. Capital gains tax applies only to appreciation above the stepped-up basis, and only from the date of death forward. Sell quickly, and there's often little to no gain at all, since fair market value hasn't had time to move much between the date of death and closing. This is generally the simplest path from a tax perspective, since you're not layering any additional strategy on top of the basis reset. You're just realizing whatever limited gain has accrued since inheriting it. Number two would be to rent it out. This is where the stepped-up basis becomes a real, ongoing asset instead of just a one-time gain reduction. You get a fresh depreciation schedule based on that full stepped-up value, starting at a new recovery period as if you just placed the property in service. If the property has meaningful value in its structure and components, this is a strong candidate for a cost segregation study, breaking that stepped-up basis into components with shorter recovery periods and applying bonus depreciation to accelerate a large share of it in year one. Because your basis is reset to current fair market value, the depreciable amount available to segregate is often significantly higher than it would have been under the decedent's original decades-old basis. That said, you're now in Section 469 passive activity territory like any other rental. Losses are passive by default unless REPS or the short-term rental loophole applies. So pair this path with whichever of those two fits your situation. And third, move in as your primary residence. This is where people assume the decedent's ownership history carries over. It doesn't for the ordinary case. Section 121A, 2 of 5 year test, starts fresh from when you begin using it as your primary residence. You don't inherit the decedent's years of living there. There's a narrow exception under 121D2 for a surviving spouse. The decedent's spouse's ownership and use period does carry over for that specific heir. But for anyone else inheriting the property, the clock starts at 0, and you're looking at a multi-year hold before any future sale would qualify for the exclusion. If you end up selling without having lived in the property for 2 of the last 5 years, so the Section 121 exclusion isn't in play at all, you're not stuck paying tax on the full difference between your sales price and your stepped-up basis. 2 things still work in your favor. First, under Section 1016, any capital improvements you made after inheriting the property, a new roof, a renovated kitchen, a major system replacement, increase your basis further on top of the stepped up value you already have. That directly reduces your taxable gain dollar per dollar. And secondly, selling expenses reduce your amount realized before gain is even calculated. Real estate commissions, title fees, transfer taxes, and other standard closing costs. These aren't itemized deductions you're hoping to claim. They come off the top of your sales price before the gain calculation even starts. Between the stepped up basis, the improvements you've added to it, and your selling costs, the actual taxable gain on an inherited property sale is often far smaller than people assume once they run the real numbers. Now, if the property appreciated meaningfully between the date of death and your eventual sale, maybe you held it a few years while deciding what to do, an installment sale under Section 453 lets you spread that gain and the tax on it across multiple years instead of taking it all in the year of sale. This doesn't touch the stepped up basis itself. It just controls the timing of tax on whatever gain accrued after that basis was set. So the stepped up basis is the headline, but the real strategy lives in the details. Whether your fair market value is backed by a real appraisal, and which of the three paths actually fits your plans once you've inherited it. Get the basis calculation wrong or misunderstand which use test clock applies to you, and you could end up paying tax you never needed to do. If you've recently inherited a property or you're doing estate planning with real estate in the picture, get the basis and appraisal questions answered before you decide what to do with it, not after you've already sold or moved in. Check out my prior video on installment sales if you want more information, and subscribe for more strategies like this every week.